Rodgin Cohen, we're talking about the senior chairman of law firm Sullivan Cromwell, which represents many Wall Street firms, the go-to man who's represented Bear Stearns, Lehman during their quest for a bailout. Rodgin, good to see you.
Pleasure.
Did we learn today that the countries that make up the euro, those 17 nations, are just too big to fail?
You know, I think we've made a step in that direction. But this has to be in perspective, and I'm fond of what Winston Churchill said after the Second Battle of El Alamein. This is not the end, this is not the beginning of the end, but perhaps it's the end of the beginning. And that's important to get to that point. A
first step, as President Obama said.
Correct.
Let's get through some of the nitty-gritty. The banks, you're focused on the banks. 50% loss is what they take for their holdings of Greek debt. You say it's a fair deal. Why?
I think it's a fair deal when you look at the market price of this debt. The market price is less. There was probably something like a 40-60 bid-ask spread. It's something also the banks can tolerate.
Can they? Are they going to find ways around this to try to alleviate the pain?
No, I think they really do wind up losing 50%, and maybe there's some small or medium-sized bank out there with a real problem, but I'm quite confident that the largest banks will not suffer severely from this.
As we've been accustomed to, high drama going into these talks last night between the banks and the leaders. I want to play for you this soundbite from Jean-Claude Juncker, who is the Prime Minister of Luxembourg, about just how those discussions went.
It was the fiercely delivered wish by Merkel, Sarkozy, Juncker that if a voluntary agreement with the banks was not possible, we wouldn't resist 1 second to move towards a scenario of the total insolvency of Greece.
So were the banks backed into a corner, fiercely pushed by Merkel and Sarkozy? How voluntary was this?
Well, I've gone through that myself, where a senior administration or senior Federal Reserve official calls up banks and says, this is what you're going to do. And when asked if there is an option, you are told no, you learn what to do quickly.
The other issue for the banks here as part of this plan, the recapitalization, almost $150 billion worth. Where does that money come from?
Well, the release suggests that it's first the private sector and then the governments if the private sector doesn't work. I have wondered whether the best solution wouldn't be a combination of the two, whereby there is an initial private sector investment combined with a promise of government support if more is needed, and then further protection for those initial investors so that if the government has to come in, most of the dilution, if not all the dilution, falls on the shoulders of the current investors today. I think that would attract a lot more private investment if they knew that if the hole were much deeper, there would be somebody to come in with additional capital.
How credible is the size of the banking recapitalization to you?
I think this number is credible in two respects. One, I think it should be sufficient, again, for the very largest banks, and I think it is credible in terms of the banks being able to raise it. What does worry me more, and it has for some time, is what I refer to as the soft underbelly of the European banking system, which are the cajas in Spain, some of the regional banks elsewhere throughout Europe. And there may need to be much more drastic action taken with respect to those institutions.
And we've seen that. We saw Dexia, for instance, needing help. I mean, was that sort of a Bear Stearns moment for you, where it was a bad omen of more to come?
No, I don't think so. Dexia is a very unusual institution. It is indicative to some extent as being owned by governments, which I don't think is a very good idea as a general matter. But it had a very concentrated and specialized business. So I think that was more of a one-off than indicative.
Now, what happens if the banks don't play ball here in this deal with Greece? Can we find ourselves, say, in this situation 6 months down the road?
If the banks refuse to do so, yes, then we could be back far quicker than 6 months. But I think the banks understand where their interests lie. We can't have this continuous negative feedback loop between the banks and the sovereigns. It's got to be broken. And by doing this, you take a very favorable first step to breaking that loop.
And about the CDS, they've been such a critical element here. The credit default swaps, investors buy them to hedge themselves against a default. If they're not triggered with this 50% haircut, therefore it's not a credit event. How credible are buying CDS?
I think it may cast a pall, but what I think it will really do is create an immediate need to look at how CDS is written so that what people think is a default really is a default.
Really is a default. What about the fact that Greece now has to grow, Italy now has to grow, it needs to take these cuts? How predicated are these terms of the plan on that happening? And that's a risk.
It is a risk. Banks are not the engine of the economy. They support the economy. And if the economy is not doing well, the banks aren't going to do well. So if you talk about the greatest risk to what was announced today, it's the overall economy of Europe, not the specifics of the plan.
All right, Rodgin Cohen, thanks so much for coming by this evening from Sullivan and Cromwell. As he said, it is not the end, it is perhaps the beginning of the end.